Good afternoon, everyone. So if you can see if you cannot see the screen, of course, you can see both my face and the screen. So you have two options. So if you can't see the screen, let us know. So okay, so welcome to another monthly wrap up. So end of first half of the year, end of June. And to be honest, probably this is the month where a lot of people at least recovered some of their losses or at least made some money. Couple of new listed companies, and we'll talk about that in a short while. So let's discuss. So, what happened last June 2020? What to watch out for in the first month of the second half of the year, and then we'll mention you to your stock picks. So, what happened in the month of June 2020? So, let's take a recap. So, for the month of June, the PSCI went up by 368 points, or that's 6%, to close at 6,207.72. Keep in mind, we were as high as 6,600 within the month of June. So that's how high was the PSA in terms of how it rebounded. But year to date, no, of course, year to date, we're still down by over 20% at 6,207.72. So if some of you are curious in terms of performance compared to the Asia Pacific region, we're actually one of the laggards. And it makes sense if we were to base it from the number of COVID cases. Why? So the top three COVID cases, at least in the Southeast Asia, are Indonesia, Singapore, and Philippines, right? And those three are actually the ones lagging compared to other Asia Pacific indices. So it makes sense, right? So we are one of the laggards. So what supported the market? So what made us rally? So these are the three things. So first of all, we rallied after the government announced that Metro Manila will be placed under a more relaxed general community quarantine. So, of course, keep in mind that around 60% of economic activity is found in Metro Manila. So, as a less stringent measure means some businesses are allowed to reopen. So, that supported the rally. So, of course, we also saw some rebound in global economic data. So, recovery in the US, like home sales, manufacturing data globally. So durable goods orders, durable goods meaning the heavy machineries, the cars. So there's a recovery in terms of data. So probably lots of investors, traders speculating that we've hit the bottom in terms of data. So that's why they bought the lows. So of course, another one is aggressive central bank monetary policy. So just last June 25, the BSP surprisingly cut by 50 bips. So interest rates now are around 2.25%. So almost all analysts said, or almost all economists forecasted that the BSP won't cut rates. So what the BSP did is they did cut rates as they want to stay ahead of the curve given what could happen next in terms of the pandemic. Of course, no, nothing is certain at this point. So what dragged the market? Of course, so we were as high as 6,500, 6,600. So what made the market or what dragged the market? So of course, the fears of accelerating COVID-19 cases around the globe. So specifically, we saw record high cases both in fresh and total cases here in the Philippines. We're seeing resurgence of cases in Beijing and even in key US states, specifically in Texas and Florida. So keep in mind, Texas and Florida are one of the biggest states in the US. So there, and also after the economists, after some economic organizations gathered more data, they saw they can now take into account more into their forecast. That's why they revised it downwards both in the Philippines and globally. So from IMF, no, I want to let's discuss for the second asterisk from IMF International Monetary Fund's April report. So what was mentioned there was they forecasted Philippines to grow by 0.6% for the year. After taking into account more data, they said that they would revise downwards to negative 3.6%. So same with S&P, no? From zero point 0.2 contraction, now they're forecasting negative 3% contraction. So keep in mind that the government's forecast or the DBCC So those are where the economic finance czars are. They're forecasting -2 to -3.4% for the whole year. So that's in line. It's in line. I would like to discuss though IMF's forecast globally. So here's the slide for it. Okay. So prior to this, no, they have a report last April. Let's take a look at global economy 2020. So what they forecasted before last April was -3%. Now they're seeing -4.9%. So mainly due to lower than expected private consumption. Of course, they saw the COVID as somewhat dragging. They expected to at least the recovery to last longer than expected. And also lower investment, of course. No, we are seeing companies both globally and here, even here in the Philippines. We're, yes, no, we're seeing both in the Philippines and globally. We're seeing lower capex, lower capital expenditures, meaning companies are inclined to spend less. So there. Sorry, I think someone's on. Hold on. Okay. It's okay. So there. Okay. So next is we are seeing there lower investment, lower capital expenditures from both globally and locally. So that's where the forecast of the IMF is hinged on. So you're seeing lower growth for advanced economies. So what mainly dragged there was the lower expected growth in the US. So specifically, what IMF is seeing, specifically in the US, is a contraction of 8% for the whole year. Right. So for France, you're seeing -10%. In Spain, -10%. Of course, that's where the bulk of the sickness were in the second quarter, the early second quarter, right? So there. Okay, so let's move on to charts a bit. No, needless to say, no, this correction is expected at least from our end. No, after a really sharp rally at the start of June, we expected the market to correct mainly because we thought the rally was too sharp. We thought this market could take a breather. And then, of course, now if you know technical analysis, when you take a look at the RSI, that's the relative strength index, we're now trading at overbought levels. We were trading at overbought levels. So it was this correction is warranted. It made sense for us. So now let's take a look at the chart. So the PSAI is now using its 100-day moving average as its short-term support. You will see that at the green line at the middle of the red and the yellow line. So in terms of range resistance, we still see at 6.2. Of course, we are going to use 6.2 for now until it goes back above the said level convincingly, because it's hovering above and below 6.2 level for some days now. So we will see where the market will decide at the next session. In terms of MACD, so using another technical indicator, we are seeing slowing momentum. And for those that are aware, the MACD is now trading below the signal line, which of course confirms the slower momentum in the index. So in terms of trading plan, as long as we're still above 5946 or 6000, we think in terms of technical analysis, that's still a good buying point. If it pulls back below 5946, if it pulls back below 57, now that's the time we are going to reevaluate price action wise. So I would like to mention a theme, at least for the past weeks. We are seeing breakdowns, we are seeing bearish divergences. I would like to discuss some stocks included in those breakdowns and bearish divergences. So breakdowns, we're seeing the likes of DMC, right? Ayala Land broke down of its range support. But in terms, if you take a look at the trend line, it seems it's still well supported, but it tells you that it just broke below its support. Also for BDO, right? And then also Metro Bank. So it's a theme that's been seen in banks and property, right? So they are cyclical names. So that's the trend we've been seeing at least for the last couple of weeks after we saw after we saw a resurgence of COVID cases. So there, okay. RLC also broke down. So next, we will discuss now bearish divergences. So bearish divergences, if in the previous slides we saw breakdowns, in bearish divergences, this indicates that these are the stocks likely to break down based from current price action. So Globe, you're seeing Globe trading at a strong support resistance, strong support of 2060, strong resistance of 2300. If you take a look at its RSI, you're seeing a downtrend in terms of MACD, slowing momentum, and another downtrend. And it's not Globe, only Globe that we're seeing that. No, we're seeing other stocks, the likes of JG Summit, bearish divergences, Ayala Corporation, and even SM. So this tells us that maybe the market will further correct. That's based on the price action right now. So just heads up, no. Of course, no. We are most of the stock picks mentioned in the breakdowns and the bearish divergences are our stock picks. So if you're a long-term investor, this tells us that there's room to buy at a lower price. So that's technical analysis wise, or speaking of price action only. So in terms of US market, so of course some of you may be curious that the one bull market that's only running is the US markets, right? But if you take a look at the chart of S&P 500, that's where the top 500 companies are grouped into, you're seeing after a really sharp rally since its lows in March, it now broke that trend line, right? And now it's consolidating. So this tells us, as of the moment, there's slower momentum. Look at the MACD, momentum is slowing down. Now it's if we want US markets to continue its rally, it's very important it holds above 3,000 level, or to be specific, that's I believe 2965 to 3,000. I've been watching the US markets. Actually, yesterday it retested the 3,000 level yesterday, but it was resilient enough and even closed um, significantly above. So as mentioned there at the upper left, 1.5% above pa. So if we want the US market to maintain its uptrend, we should see a break above its current resistance, which is around 3,180, right? So there, no, that's the trend now, slowing momentum. Of course, we saw a significant rally at the start of the month, and now it's consolidating, taking a breather. But now we're seeing slowing momentum. It has to resume now its uptrend if it wants to. It has to resume its uptrend in the next weeks, or else we will see more divergence and more downside risk. So that's the point here. Okay, so what to watch out for in July 2020, the first month of the second half of the year? So of course, we should see any slowing down or basically some progress in the COVID-19 cases, specifically in NCR and Visayas. Again, as I mentioned in the first part of the presentation, the PSCI is down by 20.6%. We are the one of the laggards in terms of index, along with Indonesia and Singapore. And keep in mind that Indonesia, Singapore, and us Philippines are the top three in terms of cases in Southeast Asia. So you can see a bit of a slight correlation there, right? So another is COVID-19 cases in other parts of the world, specifically in the US. Of course, no, any significant problem globally, especially the top economy, US, it might trickle down on us, on the smaller market. So we should see progress also there. And of course, as we speak, it's still making record highs, mainly because of the resurgence of cases are happening in the states where it's most populated. That makes sense, like Texas and Florida, because it reopened there. So that's the another side of it. Another is US-China situation. So if some of you are still not aware, China already passed the national security law. No, so that's much to the displeasure of probably the US government, since they oppose that. So any de-escalation of tension between US China is a risk for us. Some people may ask, is US China still can they still cause volatility? Yes. We saw slight US China news within the COVID pandemic and still affected the market. So any significant news from there will still affect the market. That's at least we should be clear about that. So as we speak, if probably what's in Trump's mind is to balance the current situation where China what China is doing is not. They're not agreed to that. And another is it's near re-election time. So Trump has to balance that. I mean, that's probably what it's in his mind. So keep in mind that the election in the US is in November. So there. Another is US and PH corporate earnings. So this is probably one of the most watched corporate earnings in a while, mainly because bulk of the mini quarantine occurred at this period, even in the US, right? So probably in the US, since the release of reports there are quicker, you will see at least in the second week of July, some US companies releasing their corporate earnings already. In the Philippines, usually you can see some at the third, fourth week of July. But given the pandemic, probably the PSC can give them at least a bit of a leeway to release their earnings. But nevertheless, they can release their corporate earnings now by July. So let's watch out for that, for any negative and even positive surprise. Probably most of us are expecting down, probably a net loss for some companies. But keep in mind, especially for index companies, the market reacts if it's better than expected. And keep in mind, the expected is really low already. So there might be room for positive surprise already, especially for some stocks. So that's why it's more important than ever to watch out for the reports, the daily reports at First Metro Sec or even other companies release or even other brokerages release. So there. And here's some economic data. So first up, at the third asset is we will see the release of manufacturing data tomorrow. So China already released there. So in terms of manufacturing PMI, they expanded. So that's good. In terms of other data to watch out for, OF remittances, trade balance data, bank lending data for the Philippines. Inflation, sure. Inflation also next week. As for US jobs report, the most important data coming out this week, specifically on Thursday. That's on Thursday night, Philippine time. So um, the expectation here is around, I believe, 3 million jobs. So if that happens, that's a new record. Durable good orders and GDP also must watch. So keep in mind on Friday, if you're watching the US, it's a holiday on Friday. It's an Independence Day holiday. So all the data that's usually released on Friday will be released on Thursday, specifically the jobs report. Okay, so let's move on to the stock picks. Before we tackle the specific picks, I would like to tell you our sector picks. So consumers actually are our top pick, but I would like to before I mention the picks and why we have a buy call on that, I would like to mention first the risk associated with the sector as of the moment. So of course, we can see inventory problems in some consumer companies, mainly because of supply related issues, probably some restriction in travel. And this is a new risk on the second asterisk is the imposition of excise taxes on junk food ranging from 10 to 20%. So this is still being talked about, but should this be implemented, several consumer companies will be hit by this. And I would like to mention this what they classify as junk food. So these include those sold by fast food restaurants such as burger, fries, fried chicken, hot dog, pasta, and pizza, even deep fried and salty snacks, sugary desserts, and sweets. So from there, we can see Jollibee, Shakey's, even URC probably affected should they impose an excise tax on junk food. So keep in mind, the government is trying to find funds to make up for the loss of revenues. So this is one of their proposals. So top pick URC. For URC, if you've been observing our monthly wrap-up, our initial target price for USD is 166. And we increased it to 178. So why? So it's mainly because of strong recovery in 2021. So keep in mind, starting tomorrow, we're in the second half of the year. So what we're telling our clients is to watch out already for the possible recovery in 2021. And URC, we're seeing URC as one of which who will significantly rebound. So why? We have four main things. So first is more snacking at home. So we do expect to see higher expenditure on packaged and branded consumer foods as these become indispensable indulgences for us now working from home individuals, some homeschool children, and others. Another is restocking of inventories. So as lockdowns are lifted and with mass transportation resuming operation, we expect these transitory challenges to dissipate. Another is pricing power. We do not expect any pressure for USD to slash prices given that there's demand for it. And another is URC. Keep in mind that URC, even prior to the pandemic, they have been implementing these cost rationalization initiatives already. So now, given they've been implementing it before pa, they're now set to benefit from that. No, given the stable to higher demand and lower cost, higher net profit or higher net profit margin. So there. Another is Robinson's Retail. So keep in mind that Robinson's Retail during the ECQ, no, even think of the worst case scenario right now. For example, if some barangays or some even the whole Metro Manila gets elevated back to ECQ, RHI will be one of the less hit or let's say more resilient. Why? Because 77% of its revenues can remain operational, specifically its supermarket, drugstore, and convenience store in an ECQ scenario. So as we speak, no, since GCQ is in Metro Manila and even in some big cities, even the do it yourself formats, the specialty stores, the toy stores can already operate. So there. Now, besides that, no, after the pandemic, we would really like to at least notice how they quickly turn around Rustan. So keep in mind, prior to their acquisition of Rustan, it was at a net loss. The company was at a net loss, and RHI prior to the pandemic turned it around within 9 months only. So post pandemic, it should recover strongly ahead. So there. Another is Pure Gold. So of course, Pure Gold being one of the outperformers year to date, especially in the second quarter on the rebound, mainly because all of its stores are allowed to operate. All Pure Gold and SNR. So for those who are new to investing or listening, Pure Gold owns SNR. So keep in mind, Pure Gold caters to the lower to middle income, while SNR caters to the middle to the higher income. So besides being this grocery company, you cater pa to all sectors of society. So you really get to have everything. So there, that's how we see Pure Gold. That's why it's still our buy pick, and we still see further upside from it, even currently and post pandemic. So next is banks. Now for banks, this is one of our our cyclical sector pick. So in terms of risk, before we mention our um, our reason why it's a buy, the risk for the banks specifically, given the slower economic growth, this will lead to lower loan growth and fee income, specifically from credit cards. And given that there's a tendency that not not actually a tendency, there's actually news that lots of small business owners are already closing down. So the tendency of default is higher recently. So this will be booked by the banks as non-performing loans. So there. So our pick for banks is BDO. So given the falling interest rate environment, maybe could put some pressure on net interest margins. We believe the robust credit expansion across all its segments will spearhead the growth of the core lending business in 2020. So there. So of course, now we have a research partner called DBS. Our DBS is Development Bank of Singapore, so they operate they operate at Singapore. They're our research partner. They cover Metro Bank for us to remove bias, and it's still their pick. And they're still yet to revise their target price, but nevertheless, it's still a buy. So same with BDO, no? Same with BDO. But the difference between Metrobank and BDO is Metrobank has higher capital levels, and they have more ammunition to lend out should they should corporates resume borrowing and spending. So there. So lastly, our sector pick is property. So for property, of course, lots of risk. Effect of mall closures, lower residential bookings, and delayed project launches. So that's the risk for property now. Keep in mind that we are seeing this risk right now, mainly because specifically banks in property are cyclical names. So do expect these couple of sectors are the ones that will lag in terms of the rebound. That's what we're seeing right now. That's what we're seeing right now. They're lagging in terms of the rebound. But for example, if there's a vaccine already, if economic activity really picks up, you will see these banks and property stocks to significantly rebound, because as we speak, they're the ones lagging. The ones leading the rebound are the holding consumer sectors. So more room for upside. So if bottom line, if you are a long-term investor and you do expect the the current situation to dissipate, to really improve moving forward, banks and property are a good bet, at least for upside. So there. Ayan. So our property pick is RLC. So for those who followed, who are following our monthly wrap up, our initial target price for RLC was 30 pesos. We lowered it a bit, 27 pesos, but still a buy for us. Why? Mainly because we like the revenue contribution from its office leasing segment amid continuous expansion plans. And keep in mind that the office leasing segment is the less hit sector within the property. So of course, you're seeing malls, residential development being significantly hit. So office, the less hit, mainly because BPOs, POGOs are allowed to operate, right? Another is strong residential project launches, specifically in China. So China is already operating, right? So it has this project in Chengdu, China specifically, and it's expected to recognize its revenues at the second half of the year. So if you take a look at the earnings, you expect RLC to be at least earning a decent profit despite this pandemic. Mainly one reason being it's gonna recognize revenue in the second half. So there. Oh, of course, now needless to mention, we do also like these property names that are going to mention, because these are the ones that are less exposed in the POGO sector. Keep in mind that POGOs are slowly getting out of the country, mainly because they can't handle the tax measures here, right? So our picks are less hit, or at least less exposed in the POGO sector. Next is SM Prime Holdings. Initial target price for SM was 46. We lowered it a bit to 42. Still a buy for us. So SM Prime Holdings, of course, as of the moment, SM Prime Holdings expect this to lag in the rebound, because it's significantly exposed to the mall and residential. But once economic activity picks up, expect this to outperform. So supporting the rally of the index, kasi si SMPH is one of the heavyweights amongst the index names. So there. We're also pricing in the passive reclamation, of course, in terms of when it will be fully utilized. So that's yet to be seen given the pandemic. But nevertheless, it's theirs. The land is theirs, and we're pricing that in. So there. Next is Ayala Land. Again, no, same with SMPH. Expect this to lag on the rebound. Heavily exposed in the domestic luxury residential segments. But of course, no, compared to SMPH, it has lower dependence on mall revenue. So that's, we can say Ali is a bit of a defensive play relatively. Besides that, it's one of the first ones that really plan to list the REIT company, right? So should they list the REIT company, this implies about 17 billion in new funds. But of course, that's based on 67% public vote. And Ali is actually enthusiastic to list their company at a 67% public float. So this will provide them better financial flexibility, which will fuel expansion moving forward. So that's a catalyst for them post-pandemic, right? The REITs. Even for SMPH, the catalyst post-pandemic is the PASA reclamation. Something to look forward to past the after the pandemic really wanes. So lastly is SM. So for SM, SM has actually been one of the outperformers. So SM is the one supporting the market. As the holding companies are supporting the market, so specifically SM, Ayala Corp. So they're the ones leading the rally. So mainly because it has strong balance sheet with ample debt headroom. The, keep in mind, recall, they actually disclosed that they will give out 5 billion in cash divs. That may be lower historically, but the point that they give cash divs and still leave some for a rainy day shows how strong or resilient the company is. So keep in mind, SM also holds leading companies, right? Number one sa banks in terms of largest asset, even in the property sector, the residential sector, right? Even in the retail mall segment. So you're seeing that being priced in. So there's still no, even post pandemic, there's still upside for this. That's what we see. And also, despite being this large of a company, they actually have less regulatory risk, right? So they're not in the eyes of the regulators right now. They don't have this big water company. They don't have this big energy company that is um, that has a tendency to be regulated or has volatile earnings once regulated. So there. So that's it. No, those are our stock picks. What I would like to mention the risk of other sectors. So for power, we're not we're not so positive in most power companies, specifically because of low power demand, especially in industrial and commercial sectors due to the new normal. Keep in mind, in the residential only accounts for around 30% of power demand in the Philippines. 70% is being driven by the industrial and the commercial sector. Commercial sectors, the hotels, the restaurants, and the like, right? We're positive on consumer staples, but we're not positive on restaurants. We're not positive on Jollibee because we're seeing weak demand due to the new normal, limited dining operations, and even now, even the accelerating COVID-19 cases, right? We don't expect dine-in operations to be fully utilized, given even despite the government allowing around, I believe that's 15 or 30% dine-in operations. So there. As for construction, it's a challenging moment because during the second quarter of the year, which was bulk of um, the ECQ, that's their peak season. That's the peak of construction season, right? And now, moving on to second half, it's a rainy season already, so expect less construction than usual, even if it's allowed. As for oil, of course, no lower oil prices, mainly because of course, no lower oil demand. We're seeing less cars on the road. We're seeing less flights, significantly less flights. So hence lower oil demand. As for gaming, no, even if Pagcor is already expecting or at least pushing for the reopening of casinos, it's still uncertain, mainly because again, no, of accelerating cases. So still challenging times for the gaming sector. So after the first half, this is the performance of our stock pick. So this is according to equal weights, right? So assuming you bought all our picks at an equal weight, you have a lower net loss or lower loss for compared to the index of 20.6%. So that's the performance of our stock picks in the first half of the year. So moving on to Another report of ours is the Trader's Playbook. So for those new investors, new traders out there that are listening in, Trader's Playbook is a report we made during the volatile times, right? We made this report mainly because how do we earn from the market during volatile times? So this is why the Trader's Playbook was made, to create reports um, even in first, second, or third liners. Of course, we have a criteria, but sometimes some third liners get in our criteria at a certain month. So bottom line, Trader's Playbook is we talk about what happened, our view, and then recommendation. And the recommendation part is quite unique because we mention when to enter, when to exit, and when to cut your losses. So talk about a report that takes into account both fundamentals and technicals. So again, one example here is we made a Trader's Playbook report on Dito, even if the price was as low as 1.6, right? And right now it's around 370 if I'm not mistaken. So these are the type of stocks you can see in the Trader's Playbook report. Of course, no, we don't only outperform in third liners, second liners. We also outperform in index names. So FGen, we initiated the report for this even if the price was as low as 17 pa at that time. Right now it's 24 and a half. So you really see upside for FGen. So that's why we created a report for it. And those who follow our report are rewarded, and you'll see the performance here. So those are red, or those are the stocks that we cut our losses in, and the ones that are in green hit our price target. So if you take a look at the lower part, average year to date, should you have bought all of the stocks, excluding taxes, you would have gained 6.4% compared to PSI performance of negative 20.6. So talk about our performance both in our long-term picks and the Traders Playbook report. So that's the service we provide for you. So before we end, of course, no, this is every month. If you want a more frequent summary and outlook, stock picks, and even if you want to know the theme of the week, I suggest you take a look at our stock market weekly podcast. So this week we talked about the difference between an IPO and a listing by way of introduction. So that's it. Thank you, and I hope you enjoy, or at least stay safe. At least stay safe and a bit of enjoy yourself in the first month of the second half of the year. See you again next month, and as always, your future first. Thank you.